4 days ago, Representative Rashida Tlaib questioned Treasury Secretary Scott Bessent during a House Financial Services Committee hearing about regulatory changes that reduced bank capital requirements by $219 billion. Bessent spent 4 decades in hedge fund management, including running Soros Fund Management. Now he's defending rule changes that cut reserve requirements for the largest banks. Tlaib presented data showing small community banks keep nearly twice as much capital in reserve compared to the biggest global banks. The context. In 2008, insufficient capital at major banks triggered a crisis requiring taxpayer bailouts. In 2023, Silicon Valley Bank failed due to inadequate capital buffers. After both crises, regulators increased capital requirements. These new changes reverse that. Tlaib's question was direct. If capital requirements are burdensome, why do small banks maintain higher ratios? Bessent argued different institution types require different standards. But the tension is clear. Institutions posing the greatest systemic risk now hold proportionally less protective capital. When megabanks fail, taxpayers fund the bailout. The hearing record documents this exchange. Let's watch, and you can assess the arguments.
Thank you. The gentleman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you. Mr. Secretary, a bank's leverage ratio is important, right?
Well, there are numerous leverage ratios. Congressman, which one are you referring to?
So, for the record, if I may, Mr. Chair, I'm going to submit the bank capital's analysis semi-annual update for the record. May I?
Without objection, so ordered.
I want to talk about the way that we look at global systematic important banks, what do you guys call it, G-SIBs, is that right?
That's correct.
That's what I'm talking about. They're banking organizations that could trigger a financial crisis if they failed, correct?
And they could trigger a financial crisis by not lending.
Yeah, so the leverage ratio is important when we look at it, right?
Again, I'm not sure which leverage ratio
Okay, so I'm
you're
looking at
referring to.
here, this chart, okay? It says Tier 1 capital. Does that help?
Tier 1, that's helpful.
Okay, so I know it's kind of hard to see, but the green line is the community banks. You see how high that cushion is? That it's about what, almost 11%? I know you can't see it. It's fine. I was going to enlarge it for you.
As an act of good faith, I'll take your word.
Yeah, so the largest bank capital analysis for the Federal Reserve Bank of Kansas City, it shows that last June, the Tier 1 leverage ratio of community banks was at 10.83%. For the banks that pose the largest threat to global system, what they call G-SIBs, this is the big banks, the ones who take all the risks. You know this, right? Their supplementary leverage ratio was about 5.8%. That's a huge difference, right?
Correct.
Okay, I'm getting there, I promise. Do you think the largest, most complex banks are roughly half are as risky in the threat that they pose to the financial system as a community bank in my district?
Well, I think, Congresswoman, that what you're neglecting to think about is the composition of the assets and the capital. So the capital at the G-SIBs can be much more liquid, where the banks in your community are much more, as we're used to seeing in the movies.
Well, let me explain to the public why community. Yeah, I understand. Community banks, though, lend out equivalent about 75% of their deposits to real economy. Some people refer to as Main Street, but we call it the real economy. People, families, communities. The largest banks only lend about 40% of their deposits into our real economy. Instead, they rapidly expand their loans to hedge funds and private equity that you're calling they can liquidate, right? Is that what you're saying? Is that what you're saying?
No, I'm also saying they hold a much higher.
Yeah, but the big banks are the ones who keep failing, right?
What's that?
The big banks are the ones who keep failing.
No, many small banks fail.
Well, that's
too.
because they're getting pushed out. We're not actually supporting community banks.
Well, as I've said, I think more than 100 times today, I support community banks, and what I don't want to see
you could say it, but you got to do something about it. But listen,
I've met with more than 200
I know,
community
Mr.
bankers.
Secretary, but this is pretty bad. Because the fact that community banks in my business have almost twice as much capital percentage-wise compared to banks that pose the largest threat to our financial system, that shows that just how much playing field's tilted towards Wall Street. You understand that, right? That's where the risk is. The big banks do far less for our real economy. for everyday people. And that's what I'm trying to say, because Trump's regulators recently, finalized a rule to modify the supplementary leverage ratio that applied to the largest banks. Many former regulators and experts have warned that such step will actually undermine the safety and soundness of our largest banks. The final rule will result in a reduction of about $219 billion, about 28%, in capital at the bank subsidiaries of global systematic important banks, GSIBs. Again, my residents don't know this, but the thing is they end up with having to pay the cost when they fail. And so I'm just trying to stress to my colleagues how important it is, because Secretary, last November, didn't regulators reduce it, again, the capital requirement, right? Yes or no? They
again,
did.
Congresswoman, I want to be polite, not say it's naive,
Yeah.
what the road you're going down, but much of the excess capital has been invested in the U.S. Treasury market, and keeping those yields low helps the borrowers who want a mortgage or a small business or an ag loan.
But are you paying attention how much they are lending versus community banks?
Yes, we pay very close
really
attention.
low.
I've been a financial
isn't it
analyst
low?
for over 40
Do
years.
you agree it's low?
Sorry?
It's
No,
still very low.
It's not relative to the historical level.
Mr. Secretary, if you came to my district, you can go to Detroit or the suburbs, they will tell you the big banks do not loan to them. And if they do, it's predatory, it's not supportive. It's the local community banks that support them in owning home ownership and small businesses.
General's time's expired.
Congresswoman, you and I are in complete
The
agreement.
general's time's expired. The gentleman from
except on the
California,
capital
Ms. Kim,
ratios.
is now recognized for 5
Okay, so if you just watched that and felt your blood pressure rising, you're not crazy. That reaction is completely justified, and here's why. According to the Federal Reserve Bank of Kansas City's bank capital analysis, community banks maintain a Tier 1 leverage ratio of about 10.83%. The biggest banks, the global systemically important banks or GSIBs, average roughly 6.9% on the Tier 1 leverage ratio and about 5.8% on the supplementary leverage ratio. That's still dramatically lower. And when Tlaib asked Bessent if he thinks the biggest, most complex banks are roughly half as risky as a community bank, he started talking about asset composition and liquidity. But here's what he didn't mention. In November 2025, federal banking regulators finalized a rule that reduced capital requirements at GSIB bank subsidiaries by $219 billion, a 28% reduction. Federal Reserve Governor Michael Barr, in his statement opposing the rule, said this change significantly increases the risk that a GSIB bank would fail, orderly resolution would not be possible, and the deposit insurance fund would incur higher losses. That's not some progressive activist. That's a Federal Reserve governor saying this rule makes bank failures more likely. Now, Bessent's defense is that these big banks hold a lot of U.S. treasuries, which keeps yields low for borrowers. But let's talk about what these banks actually do with deposits. According to research from the St. Louis Federal Reserve, community banks play an outsized role in lending to small businesses and local families, and small business applicants report significantly higher approval rates at smaller banks. So Bessent is essentially saying, don't worry that we're letting them hold less capital, they're investing in safe assets, while ignoring that community banks both lend more to Main Street and maintain higher capital buffers. And when Tlaib pushed back about big banks failing, Bessent said, many small banks fail, which is technically true, but spectacularly misleading. In March 2023, Silicon Valley Bank collapsed, the second largest bank failure in U.S. history. Then, Signature Bank failed. Then, First Republic Bank failed in May. According to the Journal of Economic Perspectives, these were 3 of the 4 largest bank failures in American history, all within 2 months. The FDIC estimated Silicon Valley Bank's failure alone cost the Deposit Insurance Fund about $20 billion. So when Bessent dismisses Tlaib's concerns as naive, what he's really doing is defending a system that requires the institutions most likely to trigger a financial crisis to hold less capital than your neighborhood bank. The strategy here is obvious. Reduce capital requirements, increase bank profits, claim it's about helping the Treasury market. And when the next crisis hits and taxpayers have to bail them out again, well, Bessent will be long gone from Treasury, probably back managing money for billionaires who bet against the economy during crashes. Here's the language to use when explaining this to others. The biggest banks in America, the ones that crashed the economy in 2008 and nearly did it again in 2023, are now required to hold half as much capital as community banks, despite posing infinitely more risk to the financial system. And the former hedge fund manager running Treasury just slashed their requirements by another $219 billion. So what does this actually mean for you? When these banks fail, not if, when you pay for it. The FDIC Deposit Insurance Fund is backed by all of us. When Silicon Valley Bank collapsed, it cost about $20 billion. When First Republic went down, regulators initially estimated another roughly $13 billion. Imagine if your bank charged you fees for overdrafting by $2, then turned around and required you to cover their $13 billion losses. And according to Federal Reserve Governor Barr's analysis, this new rule makes those failures more likely while simultaneously reducing the capital available to absorb losses. But here's the deeper issue. These rules fundamentally reshape what banking means in America. Community banks maintain high capital ratios because they're actually lending to people and small businesses in their communities, lending that requires relationship knowledge and carries real credit risk. According to the Federal Reserve's Small Business Credit Survey, 82% of small business applicants got at least partial approval from small banks in 2022 versus just 68% from large banks. Big banks can afford lower capital ratios because they're parking money in treasuries and lending to hedge funds, safe, liquid, but not productive for the real economy. And for what? Bessent claims this is about keeping treasury yields low, but Federal Reserve and regulatory analyses note the rule reduces funding costs for the largest banks. According to the Federal Register summary of the final rule, it lowers marginal funding costs for GSIBs. Translation: bigger profits for bank shareholders and executives. The same executives who, by the way, sold millions in stock right before Silicon Valley Bank collapsed. SVB's CEO Greg Becker dumped $3.6 million in shares less than 2 weeks before the failure. As of now, this rule takes effect April 1st, 2026, though banks can adopt it as early as January 1st. So we're already living under this framework, but this isn't about whether the supplementary leverage ratio should be 5% or 6% or 10%. It's about whether we've learned anything from 2008 or from 2023 or from any of the previous times we've watched this exact pattern play out. It's about whether the guy who made hundreds of millions betting on market volatility should be the one deciding how much risk the biggest banks can take with other people's money. Because here's the thing that should keep you up at night. We just watched a Treasury Secretary who spent 40 years in hedge funds defend a rule that makes bank failures more likely while dismissing the concerns of a congresswoman, pointing out that community banks maintain twice the capital cushion. And his defense was basically, trust me, I've been a financial analyst for over 40 years. Yeah, so were the guys running Bear Stearns and Lehman Brothers. If you found this helpful, hit like so more people see it, and drop a comment to tell me what you think. Make sure to share this video with anyone who needs to understand what's really going on. Don't forget to subscribe and click the bell icon so you never miss an update. Thanks for watching, and I'll see you next time.